to say that lenders are a little spooked would be true. And they're not taking the same risk. So your planning on the acquisition has to be really formatted where you have your game plan and you really have a good presentation. So I guess what I'm trying to say in a nutshell is what you might have gotten away a year ago, you might not get away today unless you have the proper presentation.
Hi, this is Chris German. Welcome back to the Apartment Dealer Show. And we're starting our interview series as we begin to prepare for our spring Apartment Owners Educational Luncheon. We'll be introducing you to each of the speakers involved. Some you've seen before because many times we bring back the same speakers because they are the pinnacles within each of their own fields. But this is to give you an idea who's involved with the event and what can they share us about their particular industry that will help you in the ownership and management of your multifamily properties. Today, we will be discussing all things commercial finance. I have with me Mr. Gil Figueroa. Gil now, for many decades, has been involved in funding apartment loans, working with apartment investors and landlords like you. I have essentially known Gil since I got in the business 16, 17 years ago. And what they told me about Gil back then is still true today, is that even the most difficult client, the most difficult property, if you need financing, take it to Gil, and if Gil cannot finance it, then nobody can finance it. And it's important to work with a commercial loan broker. You could try, as the consumer, to go to one bank and then go to another bank and then go to another bank in terms of trying to obtain financing. The problem with that is that's time consuming, number one. Number two, I've had clients have the experience where even if you find a bank who tells you that they have a favorable loan terms and rate, it might take weeks, months on end, and then only to no avail, or they change the loan down the road. Whereas opposed to working with a commercial loan broker who has a track record working with all these various banks, knowing which banks really perform versus those that don't. And in one shot, when you work with a commercial loan broker, and all the full disclosure here, Gil has done my loans for my own apartment buildings, but it's because Gil offers great service, had the best product to offer at the time at which I needed a loan. And the bottom line here is, in one call to Gil, I already knew what all the available loan programs were amongst many, many banks, and it took little to no time on my own. So that was a big lead up, but Gil, thank you for being
Chris,
on the show again.
Sure.
I want to start by just going through a couple, what for you and I are basic acronyms, terminology, but go through some definitions here so that as we go through our conversation, the consumer is not lost, the landlord is not lost. First, LTV. What is LTV? How do you calculate it?
Sure, it's loan to value. So you divide your loan amount into your acquisition price or your current sales price, evaluation price.
Would you say you can also, it would be essentially mortgage over the appraisal price? Would
Yes.
that be a fair way too? Okay.
Absolutely.
DCR.
Okay. Debt service ratio. So in essence, the property has an income, and that net income is what we call an NOI. So we take the NOI and we divide that by the monthly or yearly mortgage payment, and that calculates the percentage of what a bank would allow to qualify that said property. So banks have let's call it a cushion between payment and net operating income. And typically that cushion could be 20%. So and hence the 120 debt service is basically 120% of your mortgage payment would be the number they're looking for on that net operating income.
Now, net operating income, do you include insurance taxes in that figure?
Yeah, so the net operating income is going to take everything in consideration. Banks are going to use a vacancy factor. In our market, typically 5% being the norm. They're going to take fire insurance, taxes, maintenance, utilities, management, all of it into consideration. And based on their different hurdle rates they use, they're going to come up with a net operating income, which could very well be different than your actual net operating income.
So to that point, so let's say you have a building A, and building A has a lot of deferred maintenance versus building B. Building B is turnkey. So obviously the annual maintenance on those two buildings is very different. How do the banks deal? And let's say they have the same income though. Building A and building B, they're looking to obtain the same mortgage amount. How do they determine the maintenance factor though?
Typically that's not the bank per se, it would be the appraisal. Okay. So the appraisal is going to state whether the property has any deferred maintenance or it's not to par, or to snuff, so to speak. Mm-hmm. And based on that, the bank is either going to drop the value to that equivalent number if there's a cost to cure, or increase the repairs and maintenance to cover that, to cover those deferred items. So obviously the building that has deferred will qualify for less on a loan amount, and also appraise for less value because of that deferred amount.
Now we're recording this video February of 2023, and so that's important because things are shifting, things are in flux. So today, with the need to stretch as much loan dollars as you can because we're fighting, higher interest rates, how does one appeal if you don't like the appraised value, or if you feel like, you know what, that appraiser, what he's allotting for maintenance or repair, no way, because we actually put in copper plumbing and these type of things. How would you go about doing that?
Yeah, one of the key points of using a good mortgage broker who knows exactly what lender, their hurdle rates, their underwriting, what they're looking at in their underwriting department specifically is a key component. Because what we do is we pre-screen before we submit. So pre-screening is our power play, so to speak, because then we're going to have a good idea what their acceptance rates are, what they're going to look at, and if we have an issue, we address it up front. So we address those issues up front as far as deferment and so forth. In today's market, obviously, rates have moved up. They've been down from the high of in October of last year, where we hit maybe a 433 10-year treasury. I think our treasury right now is about 3.7 at this recording. So rates have come down. What we're looking for is, if a property has upside, we're looking for lenders that'll use potentially a market rent and an actual rent and have a ability to underwrite a little more aggressively. We also have lenders that underwrite on a 115 debt service versus the norm being 120, or for instance, Chase at a 125. So we have lenders that are a little more leaner, especially if there's a good situation with upside of the rents and the right sponsor, the right borrower that has the ability or track record to bring things up quickly.
And another thing that you've done in the past is, because you've done so many loans, you work with banks, their track record and so forth, is the appraisers too. And so which appraisers tend to be more difficult to work with, we'll say, and versus those that they know their job is not to kill the deal, but just analyze the asset. How does that come into play when someone's looking either at a purchase, refinance, the ability to say, you know what, no, we want this specific appraiser?
Yeah, we, as a mortgage broker in today's environment, we really don't have the choice of picking, so to speak, our appraisers, but we do have a say if we have definitely a negative relationship, or we've seen negative assumptions from one appraiser to another, and we can deny a certain appraiser if need be. Okay, it's a rare thing. It doesn't happen a lot, but it happens. Sure. And we've come to that conclusion. Also, we do our homework on that end as well. So we have our comps that we either get from the agent or ourselves, and we present a good package of what we feel up front our valuation should be, our NOI should be, and so forth. So going to a broker, a good broker, you're not only trying to capture the best rates and terms, you're also looking for presentation. You as a client being represented and in your best light and being shown your presentation. So that's what we do. So if there's issues with a property, you had low rents or you had some deferment, we come up with what happened, we present it correctly, and then we come up with a game plan. So you, in essence, are looking positive to the bank, something that you're not going to do going direct. And the bank is never going to ask you for this type of presentation. They're just going to take data. So another plus. So that's what we do. It's our presentation of the file. It's our knowledge of the comps and the marketplace. and is our knowledge of positive appraisal outcomes and negative. And we have a say, per se. We can't pick them, but we can definitely decline the ones we don't like.
Sure.
Yeah.
You know, and I know we've had that experience before. Now, in upcoming episodes, we'll be interviewing Stephen Spear, who you're familiar with, real estate attorney extraordinaire, to discuss, you know, entities and what have you. My question for you when it comes to entity is, okay, it's a husband and wife, they owning a property in a family trust versus an LLC. The lawyers will tell you, hey, you should have everything in an LLC. But obtaining a loan, family trust versus an LLC. Is there any difference in terms of the underwriting, documentation, one easier than the other?
Well, an LLC is the norm. It is the norm. A trust, a bank is going to have to see the writing in the trust, you know, what it serves, and if it serves different entities than the LLC. It's all common sense. They're also going to look at the strength of the trust. So if this trust wants to be standalone and have, you know, no guarantee issues, it's going to have to be a strong trust that shows some performance and income and so forth. So it's all going to stand on its own merit as its own entity, and it's going to be judged on its own merit and entity.
And the LLC, so you have the managing member, and then you have the other members. Do they want to see everyone's financials? Typically,
a bank is going to want to see any shareholder that is 20% or greater. Some banks have a hurdle rate or a rate of about 25%. So it really just depends. So if you have a main principal that's 51%, then we usually can get away with just using that individual, you know, as the GP in essence, right? So it just really depends on the bank as well.
Sure.
Yeah. Some banks, we've had an experience lately with one bank wants everyone on the cap table to app. Everyone, even 5% shareholders. So it is different bank to bank.
Yeah.
So crucial to have someone who knows what the banks are looking for, what their guidelines are, and not waste time with the wrong situation.
Well, and you want to provide the right documentation, right? So in other words, you know exactly what needs to be presented, probably, and we don't want to show them that to get the best loan, the best.
Right.
Versus if you just go direct to the bank, you're going to be dealing with a loan officer, and he's going to say, okay, these are my check boxes, and give me the documentation to check these boxes, which some of that either may not be truly necessary or to your own detriment, depending on your finances.
Oh, absolutely. Absolutely. So, you know, we have, in today's market, we still have what we call a stated income program, where tax returns aren't required. Per se, and then there's banks that require tax returns. So in our pre-phase of analyzing, let's call it pre-qual, we look at your tax returns. We analyze to see if you're going to have a cash flow issue with the bank, and we can recommend a stated income program. Typically, the stated income programs are about an eighth to a quarter higher in the rate, but still definitely within range. And a lot of clients do, you know, need that option and require that option. But what we do up front is we pre-screen, we pre-analyze the property, everything. If there's an issue, we'll find it, we'll address it, we'll solve it, we'll have a game plan. If there is no game plan, no way to solve the issue, you won't spend money on appraisal or application fee, like some banks put you through it. With our underwriting and knowledge and so forth, we're going to have a pretty quick answer for you, whether feasibility or not.
So that brings up a good point. So let's say a investor is no longer working, right? Their income is solely from the property or properties they own, but on their taxes, you know, they under-disclose their income, they over-expense their expenses and maintenance and what have you. What's the viability for a loan? I mean, how does that work in the loan process where this individual, say they're 100% equity in a building, or they own 3, 4, 5 buildings. On paper, they might look like a pauper, but in reality, we know that they have money. What's the scenario there?
Well, again, we'll go back to stated income and full doc. So what we do is we analyze their returns, and we talked about a debt ratio that the property needs to have. There's also a global debt ratio that the borrower needs to have. Okay, it's usually on a higher threshold. Okay, so in essence, we analyze that debt service, property and buyer. Okay, there's 2 debt service analysis, and if they don't meet either one, we recommend a stated product. So that's something that can save so much time, because typically loan officers don't have the capacity of doing, global debt service analysis on our caliber. Maybe they don't know how to read a certain complex tax return or entity, and they don't know how to analyze that structure. So that could take a month with a bank. And then you come up with some bad news at the end after spending, $5,000, $6,000 in a month or more longer. The underwriter could say, look, your debt service on your asset was fine, but your global debt service for you, the client, because you're not working anymore, you don't qualify. Well, we're going to know that within a day or two, after our analyzation phase. We're going to know that quickly, even before you spend a dime. Okay. So we're going to know whether you underwrite full doc or stated right from the beginning. So the product we're going to offer is not just the best product, it's actually the best product you can actually fund. So there's the difference. And the reason we have a 99.9% closing ratio is because we're doing all this up front. And we have the knowledge base to be able to do it. Sure. Right. So a lot of lenders don't. So that's our forte. That comes from many years of closing loans and underwriting loans.
Well, I think investors have to be savvy enough to know that the bank can give you an LOI, a letter of intent, but that's about as good as the paper it's on, because I've seen it happen where the banks retrade. They change the terms because something comes up during the underwriting. They said, well, yeah, we would have given you that loan, but you also didn't tell us about this or what have you.
Right.
So yeah, doing the work up front. Now, so Gil, you've already discussed the stated loan programs. What other loan programs are out there today when you're trying to purchase a 5+ unit apartment building?
Well, today we're seeing a lot of different product line coming up based on portfolio lenders coming in with a different market and bringing in different products. The pricing, because they're priced on a 2 or 4 year product line or a 5-year treasury, the pricing's somewhat high, but they are getting aggressive now and then. So they're doing no DCR programs, stated income programs. There's a lot of product hitting the market right now, but our main product line that we sell is either full doc, stated income, either short-term, 3, 5, 7, 10-year fixed, and now we're doing a lot of bridge financing. So to talk about bridge, if we have a property that's massively undervalued as far as the rent capacity,
way below market,
way below, and let's say there's an infusion of cash capital to improve that of $25,000 a unit. Well, we actually have lenders that will calculate that and offer a high loan to value, which includes a loan to cost qualification. So we just closed one that had a loan to value of 80% and a loan to cost of 85. So with that being said, that one borrower got a lot of leverage on that deal, and he got, in essence, a portion of his rehab money was financed. So he took a bridge loan, which is an interest-only short-term loan, typically tied to a product either prime-based or an LIBOR index-based, which would be somewhere between, I say on the low today, maybe 8.5, high, maybe 10.5. So that's probably the range, but it is interest-only, it's short-term, and then we go from bridge to perm thereafter. We even have a product where we have a couple of lenders that allow for bridge to perm already set up.
Perm being permanent.
Permanent, right. And we set that up right from the beginning. So if the property performs as the sponsor assumed or his game plan worked, then he can go from bridge to perm, seamlessly to a certain extent.
Yeah, and so when we have our discussion with Mike Brennan, who you also know, the eviction attorney, that's going to be interesting to discuss, because now certain cities are stepping in saying, hey, even though the state will allow you to vacate tenants to do substantial improvements, and a lot of the videos on my channel talk about that, well, in this city, no, you can't do that. In this city over here now, you can no longer do that. And so you're having to get more creative, potentially buy out tenants, but the deal still may make sense even if you have to buy the tenant out and relocation fees or what have you, because if you can get the additional financing, more leverage on the deal, and depending on how much upside there is on the rents once you do the improvements, once you go to put the permanent financing in place and refinance, you may find that you get all your money essentially back that you have into the deal almost after doing that, if it's the right deal. So
right. We've seen a lot of syndication deals where they're not only improving the asset, paying the tenant off, but adding ADUs. So they're converting some garage space or even some open land space if it has, the right location and ability to add ADUs and add more units to their play, and it makes a huge difference on cap rates, the end result. And it's a completely different financial analysis.
When it comes to just underwriting in general, because again, we're at a time where the economy is in flux. You know, what's the real unemployment rate? You know, what's where interest rates, where are they headed? Are they up? Are they down? Is the Fed being too aggressive, not aggressive enough? Okay, so that's kind of where we are, right? The lenders, said plainly, is it harder to get a loan today than it was a year ago? And if so, how?
A year ago, we probably had treasuries at this time, probably 1.5% less than we are now. We hadn't had the big Fed move upward as of yet, right? We didn't really feel the big Fed move until the latter part of the year. So in essence, a year ago, the lenders were much more aggressive, okay? And there was no fear in their marketplace as far as rates going to a much higher, 40, 50% higher, which they did go, right, in essence. Sure. But nobody expected that. So now to say that lenders are a little spooked would be true. And they're not taking the same risk. So your planning on the acquisition has to be really formatted where you have your game plan and you really have a good presentation. So I guess what I'm trying to say in a nutshell is what you might have gotten away a year ago, you might not get away today unless you have the proper presentation and you have a game plan, you have an end result, and you know where your end result looks good and how to get there. So that's what lenders are looking for. So if you're looking for leverage right now, they really want to see an operator who has the knowledge base, or maybe an agent like yourself is, assisting them in what their game plan is and how to execute that game plan. They're looking for that. So they're not lending on speculation. That's over. And there is a lot of fear in the marketplace that rates will continue at the same increase of rate and speed. So there is that fear from the banks. Now, there's some talk that the Feds might pivot or not pivot. And I have a great analysis on that at our meeting that I'm going to present. I'll go more in depth and get a little more in the minutia of that. But right now, I can say that we're at a pivot point where we're going to see, the market either have a fear of either inflation or recession. So that's our tug of war today. Okay, so we have some of the lenders fearing inflation and also now recession. So that's our tug of war. I think we're gonna know where that war wins. So who wins that war, so to speak, in the next quarter?
Because it's getting more difficult to maneuver some of these things. Like investing in multifamily, that takes a strategy. You mentioned a game plan. I'll use your terminology, a game plan. That takes a game plan, right? In terms of knowing where to buy, the tenant base, rental rates, when to do cash out refinances, when to do 1031 exchanges. Takes a plan. You don't just wake up and say, yeah, I feel like doing a 1031 exchange today. When it comes to financing, do you need a strategy, or do you, I'm going to buy a building, so then I just get a loan, and you're not really forward-thinking strategy when it comes to commercial financing? What do you think?
Over the years, obviously, there's been people that have had no strategy and just done fantastic by buying. My point is, a strategy is available. Why not use it? It's a great tool. And I always ask the question, what's your objective? What's your objective with this acquisition? The old question, right? Where do you see this building in 2 years? Where do you see it in 5? Where do you want to be? What do you want to see happen? And how can we format or let's call it tailor-make a product that fits your situation? So let's say, for instance, somebody wants to come in and say, hey, Gil, I want my lowest payment because I'm going to fix it up and I'll refinance it later. But I want my lowest down payment. I want the lowest payment possible. Maybe we'll offer a bridge. Maybe we'll go to a straight arm, okay, with no prepay. We have products that have no prepay as well. So in essence, we can offer that as well, especially if it's short-term financing someone's looking for. So keep that in mind. Not all lenders have a prepayment penalty, okay? Sometimes you will find that the lenders that do for longer-term products, 5, 7, and 10, have a better yield because of the prepay. So they're offering a better yield. But if your game plan is short-term, then we're not looking at that.
And I know, at least here locally, again, the areas that we service, LA, San Bernardino County, to see an apartment building get foreclosed on is next to never. Even in the downturn between 2008 and 2010, again, in the markets that I work, I I could probably count on one hand how many buildings were truly foreclosed on, which number one tells you the strength of the asset that you own as a multifamily investor. But with respect to that, is there a pro and con to more leverage versus less leverage? In other words, I know the bank, going back to the DCR, is going to have some say in terms of the loan amount. But if a buyer has the wherewithal to say that the bank will allow them to put only 30% down, but the buyer can put 50% down, is there a strategy to that in terms of determining how would you, if they say, Gil, well, what do you think? I mean, I have 50, but I can also do the 30. Gil, what do you think? What's going into that decision-making process?
Well, the decision-making process, number one, depends on the product line they're looking for, right? And it all has to fit. So the puzzle has to all work. If they have more money, the question is, can you use that money to improve the asset instead of putting a bigger down payment? Because obviously, dollar to dollar, if you're managing the property correctly and improving it, you can get more bang out of your buck improving the property than the down payment phase. Okay, because the down payment is not going to make, maybe for every 100,000, maybe 600 a month, right? Where if you put 25,000 in a new unit, you might be able to procure that 600 right off the bat, if not more. So my point is, I believe there's more bang on the buck to increase capital improvements right, versus down payment. Sometimes we don't have that luxury, right? But it's always something to talk about and discuss a game plan. Because sometimes a bridge product, even though I know a borrower might say, wow, 7%, 8%, 9% on a bridge product, but it's interest only, okay, and it's short term, and they put minimal amounts of money in. So that extra $100,000 or $200,000 that they were able to procure a 70% loan to value versus a 50% loan to value on standard underwriting at 120 debt service, where the debt service lender, the bridge lender, doesn't do a debt service or has a much more, 0.80 on debt service, so a different caliber. So my point is, I think that is a great strategy, and I'm seeing the more sophisticated borrowers using it, the syndicators, the bigger asset groups at home.
And so that's something to ask yourself is, why is it that those individuals we would call the big boys and girls of multifamily investing, why are they taking bridge loans, right? Why are they sticking their neck out a little bit? Why are they taking the higher interest rates? Because especially here locally, and going back to my point of no foreclosures, the buildings are going to perform unless you just do a horrible job picking the wrong asset in the wrong area and terrible financing. I mean, the property should perform. You look at COVID. COVID is a great example. In the areas that I work, tenants were paying by and large, and very few vacancies are really going to occur, at least with the investors that we're speaking to. Maybe, of course, one here and there, depending on how many units you own. But I'm going back to the strength because the bridge financing many times can make sense. For example, we just started our Legacy Builders interview series. I'm going to introduce you to a client of mine who last year I sold her a 19-unit building where if you got a traditional loan, the rents were so low on that building, you would have had to have put 70% down on the property. So a traditional loan made no sense. So she took a bridge loan at a higher interest rate, and the building itself was in a city, one of these cities I mentioned earlier, that does not allow you to vacate tenants simply for substantial improvement. So quickly, in cities that allow you to vacate tenants for substantial improvement, you don't need to give the tenant any money. You just have to give them their last month of rent free, or the last month they live in the unit. But no more money has to change hands, and legally you can ask them to go. In this particular city, that's not allowed. So the only way to get the tenants out is you're going to have to pay the tenants off, essentially, cash for keys. So a lot of investors who I showed the deal to were like, well, Chris, number one, I have to take bridge financing. It's a higher interest rate. Number two, I'm going to be buying a building in a city. Who knows what's going to happen with these tenants? Who knows if any of them will take the money? And so we'll get into that story. She followed my advice as part of a 1031 exchange. She sold a couple of buildings, bought this particular property, among others. And as of today, she's gotten out. She got back 16 of the 19 units in a city that did not allow for substantial improvement and took the higher interest rate. So back to your point, Gil, and she's not a syndicator. She's a single woman doing this on her own. Not to say that women can do it on their own, but I think we get the point here is that not a syndicator, not a big boy, but doing what the big boys do, finding the right asset even if you have to take the bridge loan, because on the other side of that is what? Cash flow, appreciation, tax savings.
Right.
Yeah.
Right. Yeah, I like to say that there's a lot of negative hype out there, but you mentioned foreclosures. I spoke with CoStar about foreclosures, and I think they had like 30, in the whole LA County.
That was crazy. Now, let's stop it. I hope you guys caught that. So CoStar Group,
all assets.
Yeah. So if you guys watch my market, update videos, CoStar, that I always say, hey, we're using their analytics, we're using the analytics. They told Gil, in all of LA County, across all asset classes, warehouse, office, industrial, multifamily, can you imagine how many thousands and thousands of properties there are? 30 in foreclosure across the whole spectrum. So I guess that speaks, of course, to the strength of real estate here in Southern California. But if we're talking about multifamily, I would venture to guess, and I don't know this, but I would venture to guess the least amount of those was probably a multifamily, probably like an office, because office is a tough deal right now with people can work from home. Right, going back to the strength of the market and the asset.
The syndicators are making their acquisition price on future value, and they understand the metrics. I was on a webinar with Albert Brooks, who handles all West Coast Chase multifamily financing, and he said something that floored me. He said in his whole portfolio, they don't have a 30-day mortgage late.
Wow.
So that gives you an insight that, the market is not falling apart in any way. The market just shifted because of interest rates. And if we get interest rates shifting again, the market is the market. Right, it shifts the other way. So my point is, no matter what technology does, you have to live somewhere. Okay, so technology is never taking that product away from us, like other businesses per se. So my point is, these syndicators aren't raising capital and buying with this game plan that really only makes sense for a 1 or 2 year thereafter return, unless they have some metrics.
Right.
Right. So, and the product has always performed, and people always need to live somewhere. So my point is, the blip on the screen with rates went up. Yes, it affected it. 1%, like we talked about, 1% of rate increases will drop the available loan amount 12%, typically the value 12%. So it's just a metrics of that arbitrage.
It's the give and take between rates and cap rates, and that's where we are.
Right, right.
So we have our upcoming educational luncheon. Gil will be one of many speakers that we'll have with us. In years past, you've always done well at we'll call it a prediction in terms of, sometimes short term, sometimes a little bit longer term, but what the rates are going to do, what the market, the financial markets are looking at, and so forth. What do you think is going to be on your mind come the end of March when we have our event?
Yeah, by the end of March, I'll have an outlay of what we'll probably see for the remaining part of the year. And I think this tug of war between inflation and recession will be resolved, so to speak, with the data that's coming out. So we're going to see what Fed position is going to be, and we're going to chart out what more than likely the Fed's stance will be. Okay, and the chart will portray the future before it happens. It's done it many times before. Yeah. So we're going to know, the direction of rates and everything else. But again, we're going to bring that up and all that at the seminar.
Yeah, and when Gil says his chart is this chart that he builds out, that's all data, not his opinion, it's data. I'm not a financial guy, so if I could look at it, I can't make heads or tails of it. But essentially, Gil's able to tell us, and has done it many years now, probably for about the last 4 or 5 years now, exactly what's going to happen short-term, long-term in terms of rates and so forth. So, well, we look forward to that day. We look forward to you being in attendance. Thank you again, Gil.
Thank you, Chris. I look forward to it.
Thank you. Thank you for your time. So for those of you that own in our area of service, you're a multifamily investor, our event is coming up. The reservations are not open as of yet, so please don't contact my office just as of yet. As I mentioned as well, we have our other speakers that are going to be coming along that are going to address the areas of real estate law, market forecasting, taxes, and the rest. And so you want to plug in for those interviews. In order to know when those interviews are released, make sure that you have subscribed to our channel. Give this video a like. Be sure to turn on the alerts so that you are alerted when those videos come available. Share a comment below. Let's get the discussion going. What are your thoughts? Do you think we have it all wrong, that we have a wrong perspective in terms of the market and rates, what have you? Please share that below. Gil and I would love to read those comments. And until we are together again, this is Chris German, the apartment dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.